All right, here we go. Connor Young, welcome to Roadmap to Retirement.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Thank you for joining us. I've been on your podcast twice now, so I figured it was all time to have you come back this way. So we're excited to have you. I'm really bad at doing introductions, so outside of your name, tell the people who you are, what you do, and tell them about Buckets Capital.
Absolutely. So super excited to be here. Thanks, Alex. Yes, your story is amazing. So thanks for coming on our show and happy to ask, or I guess go through a few things on ourselves and baskets and how we serve clients. But truthfully, we love to serve a ton of different groups of people. So call it retirees, pre-retirees, and then lots and lots of business owners. And I think the realm of exit planning, succession planning, legacy planning for a lot of people that might not have businesses, especially all three of those wrapped in taxes, is just such a huge thing that people are thinking about and asking about a lot recently.
Okay. So I'm realizing I misspoke. I said Buckets Capital. It is Baskets Capital.
Yes,
Did you notice me saying that, or is that just my own?
I did. I was just gonna run right through it. It didn't matter.
Okay.
It's
I
okay.
apologize. We'll move on from that, though. So one of the reasons that I wanted to have you on, and one of the things I thought we might cover today, is you do a lot of planning with business owners, specifically on the exit planning, which I think is
Yeah.
something a lot of people don't think about when they're in the weeds of building a business day to day. They're living their life, they're raising a family, they're paying their bills, and they built a successful business over time. And then for them, different than like the W-2 employee, their business is a significant, probably the biggest piece of their net worth. So like really striking not only the timing right, but the price and all the things that go into an exit strategy so they can sell their business and live off of that revenue or that income is very critical for business owners. So you know that. So let's start with how you got into the business planning, business exit strategy part of our industry.
Yeah. Very good question. It's close at home because I grew up in the house with a mom and a dad, both business owners in some sort or fashion. And I got to see the founder entrepreneur journey immediately. And there's something to be said when you're running a business and you spend all of your time working, and it's not necessarily hey, I have a job and it's salary dependent, but similar to lots of things that we're seeing online right now with high equity comp plans, employees of, people that work at SpaceX or Anthropic or OpenAI or you name it. And so much of the net worth is just tied into that. That is very, very similar to a business owner. They're working, sweating, crying day after day, year after year, building something awesome. And that is where they've tied up their retirement. They could have a 401k that they started. They could have some other pieces that are involved with benefits or something within the company. But the company's value itself is it. That's kind of where they put a ton of their eggs in the basket. And when something is your baby for so long and you've cared for it, you've grown it, and you suddenly think of retirement years, it's going to be very different than some great people that work on or Chevron, Exxon, like an oil and gas company. And then they get a massive 401k, maybe some good pension accounts or some other things, and they're good. Like if you run a business, there's not some immediate, oh, here's exactly what to do. So lots of people have those questions and problems. And, I've been able to serve family with lots of other family members actually that even run or have run businesses and exited. But being able to understand not only, okay, the emotional side of exiting, what it takes on the tax side, what does that mean if you were to exit, there's a windfall, the trillions of different plans that you could even go through when you sell or exit your company, and how that all ties into whatever type of retirement or legacy life you want to leave next chapter is just a kind of big piece of where we start.
Sure. I think listening to you describe your journey, your parents, like how that kind of
Yeah,
motivated you, I think of in my experience working with business owners, like there's two camps that people fall into. There's the guy that owns a business who thinks it's going to be worth millions of dollars someday, and then he's
sure.
65 and he goes to sell it and he finds out the market's not what he thinks it is.
Yeah.
And the mistake that guy might have made along the way is he never actually saved outside of the business. He was just always banking on this business was going to make him rich. He was going to sell it. He was going to be all set for the rest of his life.
Totally.
And then he gets there and realizes that's not true. And on the other side of it, seemingly more common is the person that never really thought of their business as like something that has value. And they were just chugging
Yeah.
along, building the business for years. And then
Yes.
65, they want to retire. They like go out to whatever the marketplace is for that. And they say, yeah, I'm thinking about selling. And somebody comes back with an offer and it's like $10 million they never thought they'd have. And they're shocked by that. And
Yep.
they had this windfall of cash in management. And I think myself as an advisor, I'm sure you would say the same thing. Like we want to bring those people to the middle on both sides of the extreme. And whether it is worth $10 million or $10,000, let's make sure that fits into your plan because the $10,000 guy needs to be saving and supplementing that. The $10 million guy, even though it seems like he's all set on the surface, if his exit's not for 20 years, 10 years, whatever it is, there's a major concentration risk there, right? Like he's
That's what I'm saying.
not
Exactly.
diversified. He owns one stock and it's a business that he owns or he runs day to day. So
Sure.
he's biased. He thinks it's never going to fail. And we have stories of the opposite. Now I've rambled for a minute, so I'll pause there and let you fill in the
No, I
gap.
think you're spot on. Those are kind of two camps, one that may overvalue the business or some that just undervalue. And I mean, Chat, GPT, Claude, like tons of great resources out there where you could say like, hey, here's my business, here's what we're doing, financial or the numbers, P&L, etc. Like, what do you think we're valued? And there's so many resources you can kind of get to a good potential answer, but there's still it's still so dependent. It's like what kind of food do you like? And you could have the majority of like most popular foods out there, but truthfully, someone might look at your business and they would buy it for a 7x, your 7 times EBITDA typically, or when you're working in a certain industry such as plumbing, landscaping, maybe something more blue collar, like a lot of these great owners or business owners we work with, they're looking at 4 or 5 times EBITDA, but they're just not they don't know that some things that their business has or does sets them apart, such as your profit margin is just unbelievable and so much higher than industry norm, or the types of customers or clients or cyclical revenue producing things they have are just all pieces that can help what that valuation is. But then great. Now you get tied to a number, and how do you exit with that number? And how do you not get absolutely slapped with maybe a 40% tax, right? So it depends on how you sell, if you want a stock sale or if you do an asset sale, right? Depending on what and how many different pieces of the business you're actually going to exit or sell. These all play a part in total tax planning that these business owners or clients, if you're having these questions, you need to talk to an expert and figure out. GPT, Claude, they're super, super great and they can help, but they don't have the experience of selling the business or helping someone walk through that. You should talk to somebody who does.
Sure. I'll ask you a question. So I guess I'd like to get at what are some tips and tricks for, let's say you're 5 years out. You're not retiring today. You're not ready to sell, but you're thinking that you're getting there, right? 5 years from now, you want to sell. What are some things that we should be thinking about? And my example for this from what I've seen working with business owners is just get organized. I've run into
Yep.
way too many 60 something year old business owners where their accounting system is a shoebox. They do
Yep.
different things. They have different employees, but the roles and responsibilities aren't clearly defined. So my advice would be get organized. But what have you seen in your experience that you would say to somebody 5 years from today that's selling their business, do blank?
5 years in the US is kind of the super great sweet spot if you potentially want to exit in that time frame or after that 5 year mark. And I mean that because most businesses are set up as LLC and then S corp status. And that's great for like some pass-through tax organization. And when you started as a business, you're probably doing way, way less than you're doing right now. But your CPA at the time said do that, and it's great, it's smart. But now that you've been running it for years, maybe decades, and you do want to exit, you have something fantastic on your hands. But the best thing that you could do is set yourself up potentially as a C corp, and that's for QSBS. So in the US, you're allowed to sell your business, and if you're in any format, but if you're a C corp, then you could sell it in an instance where you can take your cost basis and then up to 10 million. And now I think it's 15 million for some of the legacy or newer edition of companies. or 10x whatever your cost basis is, and then have that be in a tax advantage sell, meaning you could basically keep all of that and you could sell your company or your business. And if you're running as a C Corp for 5 years or more, then it works and you qualify. There's a few businesses out there, you and I can't do this, unfortunately, like financial services and some other types of service companies or industries. But a lot of businesses out there, easy slam dunk. And that's the easiest way. You still have to talk to an expert, like still talk to your CPA or, financial advisor, planner team on knowing and having it all structured correctly and how to file. But slam dunk, right? If you're within 5 years or less, there's a few other things to start looking at, but that's huge, huge.
Sure. I think one thing that's interesting is like talking to, we always have to ask why in industries. I'm talking to a client, they have a business, they say, I want to sell it in 5 years. And like I could take that at face value and just accept it for what it is. But I think to push a step further and say, like, why do you want to sell it in 5 years? You might find out that like it's not that they want to sell it in 5 years, it's that they want to be done working in 5 years. They want to continue to leave the
Oh,
house every day
yeah.
and have somewhere to go. So like if you want to work for 5 years, there's a lot of ways that maybe we sell it a lot sooner. You just came off a good year, revenue's high. Maybe we want to cash out today and then write something into the sales contract where I get to stay on as a W-2 employee for the next 5 years and help with that transition. Or maybe I stay around for 5 years and there's
Yeah.
performance bonuses or incentives I can hit along the way. So I think just peeling back that layer and understanding, is it that you don't want to sell for 5 years, or that you're just not ready to be home sitting on your couch, so you need something to do?
No, that's getting to the psychology and just whatever mental place that client is in. And that's why every conversation, every sale, or any type of service, whatever people need, is different because it's based on you. Like you just said, some people just want to be 100% done working. What does that look like? They run the business, so they don't have a 401k and they could leave Exxon or Chevron and they're good, right? How do they do that in the most advantageous way to them, meaning most money in their pocket? And kind of carry on with whatever they want, right? So some people might want to work, some people want to be 100% full stop. It depends. Planning is different.
Yeah, it's different for everybody, which it kind of makes this podcast format difficult because it's like I'm imagining different people I've had conversations with, but the listener has a totally different situation. So let's change it up a little bit. Let's time travel for a minute. So we've been talking
Yeah.
about this 60 something year old that's ready to sell and be out. Let's say we could time travel and talk to like the 30-year-old version of that person. So you're 30-ish years old, maybe you've just started that business. What are some things that that person can be thinking about with the end goal of someday cashing out and selling the business?
Similar to what I said about your tax setup or entity structure right now, if you're S Corp, that's great. And then if you want to switch to C Corp, you have to do it for at least 5 years on a full plan. But take it a step further in terms of the setup you're doing as a 30 something year old and you might want to sell, you have to potentially timeline and game plan it out. Meaning you can sacrifice now, and if you know you're not going to sell for, let's call it 20 years or something, you can keep your profit margins pretty low, right? You don't need to make it look really, really attractive on paper, which is balance sheet, your P&L, and what other investors or buyers, PE firms even could look at to see if they want to buy your company. And you could structure it so you're putting as much money in your pocket right now that you can and not making the business look super fat and happy, right? On the flip side, if you're in your 30s and you're thinking about a shorter time frame, then there are some things that you probably want to do to make the business from, the revenue generated, profit margins, operating margin, and what you're showing on your balance sheet and P&L to look more enticing. So you have a clear 5, 7 year kind of track history for what buyers would potentially want to look at. Now you still have full control over the business if you're 100% owner and financials, money in, money out, but you're structuring your life and the money you have and don't have in between these different accounts that give you a better appearance for the potential buyer. You're already kind of planning for it.
Okay. Makes a lot of sense. I think, one mistake kind of outside of this valuation conversation that I see a lot of people make is just like not saving outside the plan. We talked about that earlier. Like you, as a
True.
business owner, you have this image of you someday selling your business for boatloads of money, whatever we want to call it,
Sure.
and it doesn't always play out. So like one of the things that I try to help young business owners understand is like we want to be investing, whether it's in a 401k plan or just a non-retirement plan, something like
Yeah.
that. And they struggle with it because compare them to their friend that's a W-2 employee at the corporation down the street. The W-2 employee starts on day one and the HR manager hands them a packet or electronically hands them a packet and says,
Sure.
here's your 401k plan. We've automatically enrolled you at 3% contribution. Go in and increase it if you want to, but at least you're already saving something. And as a
Yeah.
business owner, it's all on you. Like that's kind of the nature of it, right? Is you need to consciously make the decision that I'm going to start setting aside X amount of dollars per month or per year. And if you don't do that, no one's going to do it for you. So again, to reiterate, the mistake I see is not actually saving outside of the value of the business.
Yeah. So big. And a ton of different perspectives, opinions on this. We have what we call 7X rule. So you take your annual expenses, right? Not necessarily business, but can include business, and then your household or personal expenses. Multiply that by seven,
Yep.
right? And when the business itself or total top line revenue hits that number, then you have the excuse of, should I put my money back in my business? Like it's growing and like that's where I'm getting most of my income versus putting money outside of it, like you're saying, like 401k, different accounts, maybe real estate or some other alts. And I kind of just show that people can do what they want. They may have more of a preference, like no, bigger number or less. But that's a pretty good rule of thumb that we've seen. Like if you do
Okay.
the math, hey, I have 100,000 in expenses, and great. And when your business gets to 700 top line revenue, like gross, like I'm not taking expenses or stuff out of that, that's a really good standing point because then money that you're making that you can then take yourself or as personal or just business owned assets or investments, you could do the 401k, you could do some different real estate, you could do a bunch of other things too that would then help alleviate, I don't know, let's call it some of the concentration risk of, oh no, 100% of my net worth is in this business that I'm running.
Okay. So let's walk through that one more time. So you've got $100,000 of expenses. You're saying
Sure.
times seven, so $700,000. So once the annual revenue of my business reaches 700,000, that's when you would argue it makes sense to start saving outside the business. And before
That's
that, I'm
when
just focused on growing the business.
Yeah, and I've had clients that they'll have a 401k or they'll have some money they may set aside into a brokerage account, but they're not treating it seriously because they're doing the math in their head and they're like, look, while I'm small, a certain size business, whatever, you can claim small is under 1 million or not, but they're saying, why would I not just take the money and just reinvest it in my business? Like my return on that investment, if I know I can take $3,000 a month that I'm spending on Facebook ads or ad spend or something, right? Instead of just putting that into a brokerage account, I'd rather do that in ads so that I can grow because my return is 4 or 5x on what I could get on top line revenue, potentially. I'm making
Yeah,
up numbers and
that
examples
makes
here,
sense. And
but
there's always a
yeah,
trade-off. Dollar I spend on my
that's
business is a dollar I can't
absolutely.
invest.
And it's really, really good. And that's why I say it's opinion based. Like it's a rule of thumb we kind of use and talk through, but we have clients of constant different perspectives and opinions, and it's fine. But they have a really good point in pushback to say, listen, Connor, I want to keep putting this money that I could be doing in brokerage accounts or retirement accounts, so it's not so heavy into the business. But I know I'm just going to hit a certain, I'm just going to keep escalating that top line revenue when I do these things for my business. And that's where I want to continue to grow and do, which is the trap. Like, how much is a good number and when should you start or not start? And I say hit that 7X number and then seriously consider, meaning you then start maxing out your 401k. You then set aside some money you can put in a brokerage account, or you're looking at real estate plays and you're buying different properties or something else, even as a tax advantage play too, depends on how you're doing your taxes. That all then plays into, okay, I'm not 100% in my ABC landscaping company or whatever it is.
Okay. I think I like that as a framework. I think of possible pitfalls as like the guy that's always starting a business and that never gets off the ground.
Yeah.
Or just like somebody that's, you have really successful businesses, and then we have like the middle tier where they're making a living, but maybe 7X never really happens for them, and then they never actually save. So I think you got to be, I would argue you need to be cautious depending on the
Very careful.
specifics of the
True.
client, which I'm sure you agree with.
Yeah, totally. Like if you're at a business, running a business, and let's just say it's doing 500K and your expenses are 100, right? And that's 500 gross. So you still have tons of expenses for the business and could be a part of that 100 or not, or some other things that you have to deal with, where you have to make the call of, yeah, it's not growing. It's been 500 for the last 5, 7 years, whatever. And if that's the case, great. You can still, it's a good lifestyle business and something that's just really, really good and producing for you. But how do you alleviate that concentration risk? You're absolutely right. So that's why, yeah, every business, every client is different. And
Sure.
you kind of have to know or just view what you're doing as a part of the plan. Like there's pros and cons and risks, positives from or for every type of strategy.
Absolutely. There always will be. I think of myself as a business owner and like, like the way I approach my own finances, like I do fund a brokerage account. And part of the reason I do that is because in the back of my mind, if I run into a business opportunity that's going to cost more than I have on hand normally, I do have the brokerage account to fall back on. If it's a
Nice.
opportunity to purchase another book of business, if it's an opportunity to hire somebody and I'm not quite in a cash flow spot to do it, I can have this cushion built into my own plan. So I think that can make sense. And like 401k too, I would never tell somebody to take a 401k loan necessarily. Like that's not plan A, but it is a plan. If I need to take a loan for my 401k, I can do that. So in a way, it gives you liquidity where just putting everything into your business, you don't really have that liquidity.
Yeah, it's fair. And I mean, I think that's a really good strategy. Clients or business owners themselves can and probably should do that. I would still then consider it not necessarily investments outside of potentially the business. Because then it's like, okay, that's an investment account, but it's still wrapped under business LLC or whatever it is because it's for the use potentially of hiring someone new, of doing more marketing or a different strategy or something that you just mentioned. Like
Yeah.
it's a different account. It's not a bank account. Like it'll grow potentially with returns, but yeah, you're still mentally, psychologically treating it as like, okay, this will help the business itself grow. But it's kind of a both and, which is fine.
Yeah.
Totally good. I do
That's one
that
of the
too.
hard things. If you're a solopreneur or you own a business, like if I own 100% of my business and I own obviously my own personal accounts, like there's not really that much of a distinction. It's all
Fair.
fine at the end of the day. But
Yeah.
cool. Let's move on from that. So we got a few minutes left. I want to give you a chance to talk about anything that's like a common question that's coming up right now, anything we haven't covered, but what are the people asking you?
I think right now, and it's just so AI heavy in terms of businesses themselves, there seems to be a new consulting group or company that's just trying to do a trillion brand new things for businesses, especially with AI
Sure.
from an efficiency standpoint. And if I'm talking to client and specifically business owners, they're having to weigh options of this might make myself, my life, and the business a lot more efficient and easier. And how do I do that? And what are we going to do in terms of my financial plan, handling taxes, looking at different things so that I'm completely 100% always on the same page. So I know what's going on and my team knows what's going on. And I say my team as in Connor, financial advisor and team, and then they could have a CPA, they could have lawyers or everything else. And that's kind of been the big thing they're asking. Like, how do I know or how do I get everything always on the same page? And AI, yes, helps that and it's constantly improving. But I love being able to have those conversations with and for clients because it's like, hey, we're still going to manage, control, run full plan, and here's how we're using AI to do that. But if you're wanting it from a great streamlined approach on communication, like this is probably the best ways that we're using it. And even I've had business owners copy some of the things that we're doing and like integrations with different CRMs or whatever they're running internally. And that's been awesome. But I think this world or this giant wave of AI is changing everything.
Sure. Exciting time to be in business. Do you find that people are hesitant to use AI, like especially older business owners that they're not as tech savvy as you are, certainly, but like, do you have any pushback there?
Yes and no. I think they need to have a level of comfort with something. And then it's similar to even why would they hire an advisor or start to work with a company or somebody in general. If it comes from a referral or someone or place of trust, an expert, they're like, okay. They just see, I get this a lot. They just replace the word AI with magic. And they're like, look, this is what I want. If you can get magic to do it, great. And they're totally happy with that. And then on the flip side, it's funny. So this is a relation to our job in investment management. When they really start to see certain things that AI can and will do, they then become very interested. They see what it's going to be. They're like, Connor, what are the companies that are responsible for making this magic happen? What are the data centers or the hyperscalers, or what are the companies doing all the copper cabling inside of these things? Like, how can we utilize my money and my investments so that we get this exposure? Because this feels like we're on the brink of like 2000 with the internet.
What came after 2000?
The dot-com bubble crash, which is what I like to remind people. So it's a two-edged sword. I'm glad you brought it up because I was
Yeah,
going
well,
to
it's
say it
interesting
too.
too because like people go down that as like a doomsday, like oh, with a dot-com bubble, but it's like, well, the internet's still a thing, right? Like the internet didn't fail, so
Yeah,
yes,
it
investors could
just
lose
got
on AI
way too
stocks, but AI could
overvalued.
succeed.
Sure. Yeah, you had companies, or I should say websites about dogs in the year 2000 that were not profitable and were basically running at like a 800x, and that was their valuation. And that's not sustainable. So there is going to be a correction, and it's our job as advisors, investment managers, to kind of navigate that, right? I think there is an AI bubble risk, but how do you control yourself through that? Because now it's been and is so much a part of the current overall market that if there is a massive, massive crash, it's going to, in just AI, it will pull down the overall market too. So how do you strategically invest and plan, save in a way that takes care of your clients, but still kind of leading yourself into an exposure that is beneficial? And in my opinion, we try to take it from a fundamental and more conservative approach. And hey, we might miss the companies that go from $10 a share to 10,000, some really risky high flyers, but we'll strategically put our clients in positions that in the long term and long run are most beneficial in our opinion.
Sure, that makes sense. That's your job.
Yeah,
That's what they're paying you for. Very good. Well, we are at the end of our time. Connor, thank you for doing this. Really enjoyed our conversation as always. Where can the people find you?
yeah, you can just go to www.basketscapital.com. Best way to probably get in touch or reach out. You can also reach me on LinkedIn, just Connor Young. And yeah, happy to chat.
All right. Thanks, Connor.
Cheers.
Cheers. All right. We did it. I never know how to end it.
Sweet.
That seemed fine. I
Do what?
never know how to end a podcast. Eventually, you just stop talking and they edit it.
No, yeah, you're just like, hey, that's great. Dude, that was really fun. Thank you so much.
Absolutely. Thank you for coming on. I think that was a good conversation. We got into some stuff that I think will be helpful to people. So it's nice to, I like to have a canned, like, when I meet with a business owner prospect, I can send them this episode and say, here's some topics that are relevant to you. So I think that'll be a good one.
Smart. Hey, I appreciate it. I don't know if it'll be super helpful or enticing, but dude, I appreciate you setting this up. I hope it's a good pod for you.
Absolutely. Yeah, we'll have it out on Madeline's gonna edit it up and I think
Cool.
we post on Thursdays usually, so I don't know if it'll be this next Thursday or maybe the one after that, but we'll get it out. We'll tag you on LinkedIn with a little clip. If you want to hit share, that helps. But
Yeah, totally will. I'll repost and give a full thing. That'd be
sweet.
awesome.
All right, man. Well, take care. Enjoy the summer. Although you're in Texas, so maybe you don't enjoy the
It's
summer. We
brutal.
summer.
Yeah. Oh, you guys are pretty hot too. Didn't you get up to 100 or something recently?
We were in the 90s last week, which is pretty
Okay.
brutal. It's humid here too, so like
Jeez.
95 and humid is rough. My golf league got canceled on Thursday because it was too hot. We'll take
Sad
it.
day. Yeah.
Yeah, it's
Got to
like we
redo the golf day. Got
know,
to add it back into the calendar then.
what's that?
I said you got to add another one back into the calendar. Make
I
up for it.
certainly will.
Sick, man. Well, hey, appreciate coming on. Let me know if you have any questions and stuff, and we'll definitely repost, tag, and all this, reshare on our side.
Sounds good. Take care, man.
Sweet. Cheers.
Bye.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA and SIPC. The opinons voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax or legal matters should be discussed with your tax or legal professional. Connor Young is not affiliated with or endorsed by Cultivate Financial Planning.